Let me take us through the disadvantages of community investing. While community investing offers many benefits, it also comes with several potential disadvantages we may need to take into consideration. And so here are, some key challenges associated with community investing. Number one is lower financial returns. Lower financial returns. Community investments offer, they often prioritize social impact over financial gains. So, meaning returns may be lower than what is obtainable, through traditional investments. The investors may have to accept lower market rates, or longer timelines for their returns to come in. You have to accept lower than the rate is lower than what could be obtained in the market, and you equally have to stay for a long time before you can see the benefit or the result of your investments. Number two is higher risk. Investing in underserved or emerging markets can be riskier due to factors like economic instability, a lack of infrastructure, or political uncertainties. So these these factors characterize typical emerging markets. And so community investments may also be an early stage business with an unproven model. These are usually, startups, early stage businesses that have not really had, a proven strategy yet, just starting off. And you are there to support these businesses because you want to affect the economy of the community. Sometimes it may not work out as expected. The company may fold up. And that is the higher risk we are talking about here. Number three is limited liquidity. Community investment, especially those in local businesses or social enterprises, can be less liquid than traditional investments. It may be hard to sell or exit an investment, which can tie up capital for an extended period. How do you exit your investment? You cannot just wake up one day and say, I'm no longer interested, I want to recover my money. It will be very difficult to execute. You can do that in the stock market, but you cannot do it in the typical community investing. So it's difficult to recover your money. That liquidity is not there. It's quite minimal. Number four is impact measurement challenges. Impact measurement challenges. So measuring the social or environmental impacts of community investments can be difficult. It could be subjective and also costly. So without clear, metrics, it may be hard to assess whether the investment is achieving its intended outcome, particularly when it comes to measuring social impact or community impacts. It's difficult because it may not involve your traditional way of measuring financial outcomes. No, it needs something quite different from that. Number five is longer term, horizon or longer investment horizon. So many, community investing requires patience with long-term commitment needed to achieve social change. So patience is the key word here. You be willing to wait and to wait and to wait for as long as your investments will then obtain or achieve your desired, community, your desired impact on the community. So it takes time. And this can be frustrating for those who are seeking quicker returns. If you're looking for quicker returns, then you should not come. You should not invest in this strategy. It's not for those who are looking for quick money. It's for those who are patient enough to see their investment, produce, real social impact in the community. And that will definitely take time. Number 6 is potential for mission drift. Potential for mission drift. As some businesses grow or face financial pressures, there's the risk that they may shift, focus away from the expected, social or community goals, and they may end up prioritizing profits, over their initial mission. And this is known as mission drift. They will kind of drift away from the altruistic, community-minded, kind of impact creation into a purely for-profit venture. So number 7 is risk of dependency. Community investing can sometimes create dependency on external capital. If not properly managed, investment may fail to develop sustainable models and remain reliant on ongoing funding. That you keep on demanding for funding, and you may not see tangible result on ground. Keep on demanding for money, and that's expected social impact may not be visible until they rely solely on sponsors, on investors. You cannot really the business cannot generate money on its own to support itself. They can't, expand. They cannot carry out the organic expansion. They keep on demanding capital, money coming in, which may not be feasible. There's that risk of dependency. Number 8 is limited market size. There's that limited market size. The market usually for this kind of investment is usually very low. So many community investment opportunities are in smaller or niche markets. Is it niche or niche? Whichever. Are in niche markets which may not offer the same scale or growth potentials as more mainstream investment options. So that scalability, that capacity to expand is always is quite minimal, compared to what is obtainable in companies that do traditional investing or that provides traditional product and services. Number 9 is regulatory and legal risk, regulatory as well as legal risk. Community investments, especially those in less regulated sectors, may face unforeseen legal or regulatory hurdles for selling. The uncertainty is always there, actually. And by the time you start encountering, legal constraint, regulatory interference, you discover that it tends to add to the uncertainty of the outcome of the entire investment process. That is it. It's a risk we must take into consideration. Number 10 is lack of exit strategies, and this is somewhat tied to limited liquidity. Exiting a community investment can be difficult as there may not be an established secondary market or a clear path for selling the investment, especially in smaller local businesses or are social enterprises. Who is going to buy the company from you, particularly in a local area? You know, except those who really have that mind to create social impact that will want to come in. And if the business is doing very well in the first instance, why would you want to sell it? That's another question we need to ask ourselves. So that exit strategy is difficult to exit the business. So despite these challenges, community investing can still be a rewarding and impactful strategy, especially for those who prioritize social change over financial outcome or financial returns. However, it's important to carefully assess the risk and the trade-offs before you commit your hard-earned money, your hard-earned capital into community investing. And if you feel you must do it, at least start with your own community, let them benefit. And if it works, you can scale into other communities, other regions, as the case may be.